Hello traders, welcome back to ComLucro. In this masterclass, we are going to break down fair value gaps step by step. You will learn how bullish and bearish FVGs form, how to identify high-quality gaps, how consequent encroachment and inversion work, how to filter premium and discount zones, and how to use fair value gaps inside a complete trading strategy with higher time frame context, liquidity, market structure, and lower time frame confirmation. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. So let us get started. Before diving into the basic and advanced features of fair value gaps, let us take a quick look at market sentiment and understand the psychology behind price movement. At the core, there are two primary forces that consistently drive how the market behaves. The first force is liquidity zones. The market is always seeking to sweep liquidity to generate momentum. In simple terms, liquidity acts as the lifeblood of price movement and is essential for the market's overall function. We've already discussed how to identify liquidity zones in previous videos, which are linked in the description. If you haven't watched them yet, you can easily access those lessons through the link below. The second force is the fair value gaps. The market repeatedly shows a natural tendency to return, fill, and rebalance the inefficiencies left behind. If you look at this example, you can see that price made a sharp drop with clear inefficiency, leaving a fair value gap. After that move, price retraced upward, filled the gap, and continued to push higher to clear external liquidity. Once that external liquidity was taken, price reversed again and filled the most recent fair value gap. This cycle highlights the core behavior of the market, where price aims to sweep liquidity and rebalance gaps. Now let us move forward and explore how to identify fair value gaps from the candlestick perspective on the chart. Fair value gaps are typically formed within a 3-candle sequence and are easy to spot on the chart as a large candle. The key characteristic is that the upper and lower wicks of the surrounding candles do not fully overlap the body of the middle candle. This creates what we call the fair value gap zone, which fills the empty space between the wicks and is drawn based on the body of the middle candle. There is one exception, where a 4-candle sequence must be considered to identify a valid fair value gap. When the first candle in a 3-candle sequence is an inside bar that forms within the range of the previous mother candle, we need to analyze a 4-candle sequence to mark the correct zone. In situations like this, if we ignore the mother candle when drawing the fair value gap, the result will not be accurate or optimized. For example, in this case, if we focus only on the 3-candle sequence and disregard the red mother candle, the identified gap would be incorrect. These concepts also apply in bearish markets. It's important to remember that these principles work across different timeframes and on any price action-based chart. Now let us look at the theory behind fair value gaps. Consider a 3-candle sequence as shown. Let us assume that this bullish sequence, which created a strong imbalance, formed on a higher time frame. To understand it from a market structure perspective, let us zoom into a lower time frame. Here we can see that price built a bullish structure, similar to the one illustrated. As mentioned earlier, the market consistently tends to fill and rebalance the gaps it leaves behind. Now, let us take a closer look at the logic behind this behavior. As you can see, price created a series of bullish movements to the upside, with strong momentum caused by heavy buying pressure and a lack of sellers. When traders see sharp movements like this and miss a good entry, they often place buy limit orders below key zones, such as order blocks and demand areas, hoping price will pull back deeply to trigger their orders before pushing higher again. This behavior accumulates many pending buy orders in that region, forming a large liquidity pool waiting to be swept inside the fair value gap. So traders, fair value gaps often contain many buy or sell orders, creating significant liquidity inside the zone. This is the main reason why price tends to return, fill the gap, and then continue with even greater strength. The presence of these pending orders acts like a magnet that pulls price back to fill the void before the trend resumes. This can offer a strong trading opportunity for us. Imagine a scenario where the price experiences a downward movement. In this case, a fair value gap, also called a liquidity gap, emerges due to the absence of buying pressure across that specific downward move. Please note that the identification of the gap is based only on the impulse up or impulse down candle together with the adjacent candles. Any other candles outside this range do not play a role in determining the gap. These pockets of liquidity voids are important because they can act as strong entry points due to the market's natural attraction to liquidity. When price is inclined to move downward, it aims to clear the potential liquidity zones above it. As a result, these zones may become areas where price briefly pulls upward to fill the gaps before continuing its bearish momentum with greater strength. As we understand the psychology behind fair value gaps, now let us see how we can use them to identify the market's upcoming movement and direction. The key factor we can consider when determining price direction is the price action that unfolds as price enters the fair value gap. If price respects the fair value gap and shows rejection to the upside, it suggests that price may move upward to reach the most recent buy-side liquidity accumulated above the previous high. Conversely, if price shows no reaction upon reaching the fair value gap, it indicates that the market is more likely to move downward to target the sell-side liquidity accumulated below the recent low. Another important concept related to fair value gaps is known as consequent encroachment. This simply refers to the midpoint of the fair value gap or the 50% level of the gap. Fair value gaps can act as areas of support and resistance, similar to other structural levels. Because of this, it is important to observe how price reacts to the boundaries of the fair value gap and to the consequent encroachment level. Let us start with bullish fair value gaps. In an ideal scenario, price reacts at the upper boundary of the fair value gap by trading into it and then closing above it. This behavior suggests that price is respecting the fair value gap. Another valid reaction occurs at the consequent encroachment. In this case, price pierces the midpoint of the fair value gap and closes above it. It is common to see price retest the consequent encroachment shortly after. In the next illustration, you can see the bearish version of a fair value gap reaction. The principle remains the same, but the structure is inverted. Just like other forms of support and resistance, price can also move through a fair value gap and later react from the opposite side. In ICT terminology, this behavior is called a fair value gap inversion. On the left, you can see a hypothetical example of a bullish fair value gap inverting and leading to bearish price movement. On the right, a bearish fair value gap inversion leads to bullish price movement. This behavior closely resembles the classic switch and test seen with many support and resistance levels. Beyond fair value gaps, the ICT method also highlights related concepts such as volume imbalances and gaps. A volume imbalance occurs when there is a difference between the open and close of adjacent candles, even though trading activity exists within that area because the candle shadows overlap. A gap, on the other hand, occurs when there is a complete absence of trading activity between candles. In a bullish gap, there is space between the high of the first candle and the low of the second candle. In a bearish gap, there is space between the low of the first candle and the high of the second candle. In the illustration, you can see the bullish versions of a fair value gap, a volume imbalance, and a gap placed side by side for comparison. In the following illustration, the bearish versions of all three patterns are shown. Keep in mind that fair value gaps, volume imbalances, and gaps can often be used in a similar way when analyzing price behavior and potential reaction areas. To strengthen our understanding of fair value gaps, let us see how to identify them on the chart. Consider a series of bullish candles as illustrated. We begin our analysis from the bottom of the candle series. Here we have a 3-candle sequence represented by these 3 green candles. If we draw lines from the upper wick of the first candle and the lower wick of the third candle, we can see a gap between them. Moving forward, we find another fair value gap inside the next 3-candle sequence. However, price later pushed downward and filled all of those gaps. Continuing the move, we see strong upward momentum. So where is our next fair value gap? By drawing lines from the upper wick of this bearish candle and the lower wick of the following green candle, we identify another fair value gap created between those candles. Next, slightly higher on the chart, we see another 3-candle sequence. But when we draw the lines again, there is no gap between the candles, meaning there is no fair value gap to identify. Once again, if we consider these 3 candles and draw lines from the upper wick of the first candle and the lower wick of the last candle, we see that there was a gap between the candles, which is mitigated and rebalanced by these 2 candles. Next, we have another 3-candle sequence at the top. If we draw lines, we can clearly identify another unmitigated fair value gap here. So in this bullish candle series, we have identified 2 unmitigated fair value gaps, one located at the top and one located at the extreme. Price often pushes back down to fill the liquidity voids in these fair value gaps before continuing its bullish momentum. Price can reverse from the upper fair value gap, or it can move lower to mitigate the fair value gap at the extreme. Both scenarios are possible in the market. The same concepts apply in bearish conditions. Now, let us take a quick look at a real chart to see how we can use the fair value gap concept in market structure mapping. Here, as you can see, the dominant direction of price is bearish. To identify fair value gaps with high probability, we first need to wait for price to form a valid break of structure. Here, we see that price pushed to the downside and broke the previous major low, closing below it. This gives us a valid break of structure. Next, let us identify potential fair value gaps formed by the recent bearish momentum. In a bearish market, it's essential to analyze the chart from top to bottom to locate fair value gaps. While in a bullish market, the analysis goes from bottom to top. Starting from this high point, we begin our review. Here, we encounter a 3-candle sequence at the market extreme. By drawing lines from the lower wick of the first candle and the upper wick of the third candle, we identify a clear, unmitigated fair value gap positioned at this extreme point. Upon closer examination of the chart, it becomes evident that there are no additional fair value gaps within this internal bearish impulse move. Now, we can see an inside bar candle pattern that formed just before the price created inefficiency in the market with this large momentum candle. As previously mentioned, in cases like this, identifying a fair value gap requires analyzing a 4-candle sequence instead of a 3-candle sequence to highlight a valid and optimized zone. Therefore, we should draw lines from the lowest point of the mother candle and the upper wick of the 4th candle to highlight the valid fair value gap. However, it is important to note that this fair value gap is mitigated by price, and we cannot consider it as a trading opportunity. So, inside this bearish, impulsive movement, we have identified 2 fair value gaps. One of them was mitigated by the price action, while the other remains unmitigated at the extreme. As previously discussed, prices are more likely to return to fill and rebalance the gaps before resuming their primary trend. Therefore, what we should do here is wait for price to retrace back up to fill the gaps it has left behind before continuing its bearish momentum. Let us see what happens next. As you can see, price pushed back up again and, after filling the fair value gaps, reversed its direction and resumed its bearish momentum. Now, let us move into essential criteria and rules that we need to consider to identify and use fair value gaps to execute trades in the market and understand how we can use them to our advantage. Rule number 1. It emphasizes that when considering a fair value gap for executing trades and as an entry point, price must lead to a break of structure or a change of character in the market. Without a valid break of structure or change of character, we must not execute any trades based on fair value gaps, because these elements are essential signals that indicate whether the market will continue in its initial direction or experience a reversal. Rule number 2. In a bearish market, our focus should be exclusively on fair value gaps situated in the premium zone when seeking to initiate short positions. Conversely, in a bullish market, our attention should be directed solely toward fair value gaps positioned in the discount area to execute long positions. Rule number 3. Fair value gaps situated at market extremes hold a higher priority for trade execution compared to those found elsewhere. Rule number 4. It must be unmitigated. Fair value gap areas are considered one-time use, meaning we focus on the trading opportunity when price first enters a fair value gap. Once a FVG has been mitigated, we do not consider it an area of interest for future trading. With these rules in place, you now have a clear framework to identify, filter, and apply fair value gaps with precision. When used correctly, they help you stay aligned with market structure. Avoid low-quality setups and position yourself where institutional flow is most likely to respond. Understanding the mechanics is important, but knowing when a fair value gap truly matters is what transforms this concept into a reliable trading tool. Now that you understand how fair value gaps are formed, how to identify them, and which rules make them relevant, the next step is learning how to apply this concept inside a real trading plan. A fair value gap alone is not a complete strategy. It becomes much stronger when combined with market structure, liquidity, higher time frame context, and precise lower time frame confirmation. On the pound-dollar 1-hour chart, price tapped into a bearish fair value gap and then continued moving lower. After that, another fair value gap formed and price once again rejected to the downside. On the euro-dollar 1-hour chart, you can see how price reacted multiple times to a fair value gap before the reversal finally occurred. This concept works across all time frames. Even on the daily chart, price forms clear fair value gap zones. This specific gap was created by strong buying pressure and sustained upside momentum throughout the session. We expect price to eventually revisit this fair value gap and offer a potential long opportunity. However, for a day trader, this area is simply too wide to trade effectively. Because of that, we need to drop down to lower time frames and refine it. Refining a fair value gap means moving to a lower time frame to locate a more precise fair value gap within the larger zone. For instance, when we zoom into the 4-hour chart, we can identify a 4-hour fair value gap sitting inside that broad daily area. This transforms a wide daily imbalance into a much tighter and more accurate zone to work with. This refinement process is not exclusive to fair value gaps. The same approach can be applied to order blocks, supply and demand zones, and other key areas. Now we arrive at the next important question. Which fair value gap should we actually trade? In this example, there are several fair value gaps marked on the chart. The basic idea is to wait for price to reach these zones and then look for buying opportunities. However, we're only focused on buying when price reaches the middle fair value gap. So why are the others ignored? If we take the beginning and the end of the most recent impulsive move and apply the retracement tool, you will see that the second fair value gap sits below the 50% level, which defines the discount zone. The other fair value gap is positioned above the 50% level, which places it in the premium area of the range. We only look for long trades in the discount zone for several reasons. In most cases, the market tends to remove early buyers. Waiting for price to reach the discount area provides a safer long entry, increases the probability of success, and lowers the risk of becoming a liquidity target. No matter where we take a long position, the safest place for the stop loss is always below the swing low. Because of that, we want our stop to remain as close to that level as possible. At the same time, our first target is the most recent high. So if we enter from the first fair value gap, there is simply not enough space to achieve a proper reward. This approach works best when the market delivers deeper retracements. The reason we're not interested in buying from the lower fair value gap is that if price breaks below the swing low, market structure turns bearish. In that case, any long position would be trading against the trend, unless we clearly identify that break as a liquidity grab, where price may still continue higher. The same principle applies when we analyze a bearish scenario. The fair value gap fits inside a complete trading setup. This trading plan is built around two main time frames. First, we analyze the higher time frame, where most of the contextual work is done. Here, we study market structure to define direction, key levels, liquidity zones, and most importantly, fair value gaps, which act as optimal trading areas and can offer high-quality setups. In the second step, we move down to the lower time frame to look for confirmations and execute our entries. Remember, this trading plan is not restricted to any specific market or time frame. However, your execution time frame must always be 2 time frames lower than your higher time frame. Based on your trading style, there are 3 time frame combinations you can use. For example, if your higher time frame is the 4-hour chart, you should drop down to the 15-minute chart to execute your trades. As mentioned earlier, this trading plan is simplified into 2 main stages. So, let us start with the first stage, analyzing market structure on the higher time frame. In this broader analysis, we apply smart money market structure concepts to define direction and key levels. To determine direction, we look for breakouts, reversals, and liquidity sweep behavior. Everything will be marked manually on the chart. We will identify break of structure, change of character, and liquidity sweeps using pure price action. This is a core skill every trader must build, learning to read and mark the market by hand. Now we can observe multiple breaks of structure to the upside, which tells us the overall directional bias is bullish. After that, the market creates a liquidity sweep above the previous high, pointing to a possible reversal. This move is later confirmed when price breaks and closes below this low, forming what we call a change of character plus. This occurs when price fails to print a new high and then breaks the swing low to the downside. This behavior shows that buyers were unable to hold control and sellers have stepped in. A bullish liquidity sweep occurs when price moves below a key area, triggers stop losses, and then quickly reclaims the range. When this happens, we anticipate a move to the upside. In the same way, a bearish liquidity sweep takes place when price reaches above a swing level, engages liquidity, and then rapidly drops back below the range. When this occurs, we expect a move to the downside. Now remember, if you're not able to clearly define market structure and direction on your chosen time frame, it is better to move on to another asset. When direction is unclear, the likelihood of making poor trading decisions increases. Shifting your focus to a market with a clearer trend helps you remain disciplined and objective. The final step of higher time frame structure analysis is identifying high-quality fair value gaps to trade. We mark these fair value gaps manually using pure price action. The goal is to focus on the most relevant and recent gaps without cluttering the chart. By filtering out smaller, less significant imbalances, we are left with clearer and more meaningful zones. Once the optimal trading area is identified, we wait for price to reach that zone and then drop to a lower time frame to look for reversal confirmations and execute the trade. This is the overall logic behind the trading plan. Here's the checklist of concepts we apply on the higher time frame. Now, the second part of this trading plan is to wait for confirmations and execute the trade on the lower time frame. After price reaches our trading zone, we need to see clear signs that the short-term upward move has ended and that price is prepared to move lower. To spot this reversal, we focus on liquidity sweep behavior and shifts in market character. A valid liquidity sweep above the previous high suggests that a potential reversal is developing. At this point, you can enter a short position, place your stop loss above the high of the liquidity sweep candle, and aim for the key levels ahead of price. For a more conservative entry, you can wait until price breaks below the recent low to confirm the change of character. Once the reversal is confirmed, we then wait for price to create new fair value gaps. This is why the strategy is referred to as FVG and FVG. This does not mean that the lower time frame fair value gap must sit exactly inside the higher time frame gap. The key idea is that the higher time frame gap defines the optimal reaction area, while the lower time frame gap offers precise entry timing after confirmation. Once an FVG appears on the lower time frame, we place our sell limit at the start of the gap and position our stop above it. For the first target, we reduce risk by closing half the position at a 1-to-1 target and moving the trade to break even. The final target is the first major zone ahead of price on the higher time frame. Now, before we look at real chart examples, I want to go over some common situations that appear on the chart and how to deal with them. In the first case, we have a very small fair value gap. When this happens, it's better to use a slightly larger area for your stop loss, so it's protected from normal price fluctuations. In the opposite case, we may see a very large fair value gap on the lower time frame. The problem here is that placing the stop below this zone would lead to an excessively large stop loss. In this situation, we can either use a smaller area below the fair value gap as our stop, or place our buy order closer to the middle of the zone. By doing this, the risk to reward profile improves significantly if the trade becomes profitable. Now let us move on to some real chart examples. On the Euro-Dollar 1-hour chart, price was in a clear downtrend until we observed a liquidity sweep followed by a change of character. Both signals suggest that sellers have lost control and that our directional bias has shifted to bullish. On this chart, we can identify two fair value gap areas, but only the one located in the discount side of the range is considered a valid trading zone for us. After marking this area, we simply wait for price to return into the fair value gap and then drop to a lower time frame to search for long trade opportunities. When we move down to the 5-minute chart, we can see price forming a change of character by breaking above this level, which serves as our confirmation and reversal signal. At this stage, we identify a new fair value gap on the 5-minute time frame and place our buy order at the start of the zone. We then set our stop loss below it and target the next key area ahead of price. Now, let us see how this trade develops. Next, on the Canadian dollar versus Japanese yen 1-hour chart, we can observe a clear downtrend with several fair value gaps present. However, after applying the retracement tool, only one of these zones qualifies as valid supply based on our rules. Once the trading zone is marked, we wait for price to retrace back into that area and then drop to a lower time frame to execute the trade following our plan. On the 5-minute chart, price forms a change of character together with a fair value gap, which gives us our entry setup. We place a sell order at the start of the fair value gap zone and position our stop loss above it. As you can see, this trade ends as a winner. Still, losses are a natural part of trading. No matter how solid a strategy is, losing trades will happen, and a loss does not mean your analysis was incorrect. What matters most is having clearly defined rules, respecting them, and applying proper risk management. When you do this consistently, the long-term results take care of themselves. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader Community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and CHoCH. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.